Hi, greetings, and welcome back to the continuing lecture in Principles of Finance. I'm Dr. Jeff Hong, and we are um, we are starting on a new topic today. Remember, our last discussion was about the risk and return. Uh, we stopped at the basically we had a discussion about the properties of normal distribution and the how the normal distribution can be used to uh, uh, make more make a precision more precision forecast about the expected return with probabilities associated, and also how it can help us to uh, prioritize the asset allocation in our portfolio, and how it can be used to measure the risk return trade-offs, right? Um, there's further there's more material to discuss as far as the risk measurement is concerned, and how we can reflect risk correctly into valuation and etc. But that topic is more advanced. We can discuss it only after we have covered the stock valuation models. Okay, so we're gonna be uh, we're gonna be starting with the stock valuation from today's lecture. But once stock valuation models are uh, completely covered, then we're gonna return to the uh, risk topics again. Okay? First of all, this is the PowerPoint file posted in our temporary lecture notes folder. So this is the only PowerPoint file. The other one is PDF, and still the third one is Excel. So I hope you are also, as you're watching this video, you cannot open it at the same time unless you use a separate computer. But you can always go to the lecture notes course materials folder and check it out yourself. So let's make first of all, a very basic distinction. When we say stocks, right, there are two types of stocks actually: common stock and preferred stock. Now, stock is also called that because in the you remember from the financial statements, specifically the balance sheet. The balance sheet is representing the capital structure. Remember that. And equity is the long-term capital provided by the owners. So it means ownership, right? So common stock means ownership. But preferred stock is not ownership. Okay, preferred stock is not true ownership, because with ownership, with every ownership, there should be a voting right. It should be a voting right. Voting right is basically is the proof that you have the voice. You have the voice in decision-making matters, right? So that's why common stock is the true and preferred stock is not. I mean, just because the name is preferred, it doesn't mean it is really, it is superior to common stock. Common stock is actually the real deal, the real stock. Now, preferred stock, um, there's a reason why it's called preferred stock, and the preferred stock is called as such because when the company pays out dividend, right? Preferred stock owners get paid first, right? Prior to the dividend paid out to common stockholders. And other than that, preferred stock is pretty much, preferred stock doesn't have anything superior over uh, common stock, especially it is lacking uh, the voting right. But also there is something else, some other, something like tax advantage. But uh, without further ado, let's go into this slide. First of all, stocks can be owned privately by private investors or closely owned by an individual investor or a small group of investors, or publicly owned by a broad group of investors. Now, when we say stocks, we generally refer to the common stocks traded in the stock market. So publicly traded, meaning the ownership is open to public, right? Anybody who buys the stock of a large corporation, generally all the large corporations are traded in the stock exchange, meaning they are publicly traded uh, businesses. Stocks of these companies are traded between individuals, one between one stock owner to the next, right? And the next, right? So most companies, large corporations are, as I said, traded in the listed in the stock exchange, and they are traded in the stock market. And when I say they are traded in the stock market, that means secondary market. So what's the secondary market? I probably mentioned this before somewhere along the way, but there are primary market and secondary markets, right? Depending on at what stage of life of the stock, what stage of life the stock is in. Primary market is so like a virgin journey, the first voyage, right? The first time the stock is issued by the company and sold in the market, that's called, primary market, right? So in the primary market, the stock is transferred from the company, issuing company, to the first round of buyers, right? That's the first primary market. And from there on, it's all secondary market, right? Think about it. I buy the first time the stock is sold to the public is called IPO, initial public offering, right? But that's the first time this company ever goes public, right? And after that, uh, there can be public offerings, like a second public offering, third public offering, but they are few and far between, right? It's not like companies can um, offer stocks every once in a while, right? Uh, Once the stocks are issued, then uh, uh, they may, it may take many years before they offer the second uh, round of sale of stocks, right? So primary markets don't exist that often, right? In the life of, I mean, the stock doesn't have any maturity, right? So as long as the company doesn't get uh, disbanded, right? As long as the company doesn't uh, uh, stop operating and completely gets disorganized, uh, the stock goes on forever, and in that uh, theoretically infinite life of the stock, there may be multiple times of primary market, but it doesn't. What I'm trying to say is it doesn't happen very often, right? Now then, from the primary market, I buy stocks, and then I hold it for about 6 months or 1 year, 2 years, and then I can sell it. When I sell it, when I sell those stocks, if I bought like 100 shares of um, uh, Facebook in the prime. Facebook went public in like 2012, I believe, or 2010 or 2012. I don't remember exactly, but um, and from that primary market, I think 2012, and from that primary market, I bought like 100 shares, and then in 2014, I decided to sell that. And then if I sell it, then I sell it to another buyer who is willing to buy it at the market price at that point, right? The second buyer is, taking over that stock from me. Of course, we don't have to meet. We don't have to know. It's all done, arranged. It's all arranged by the broker, right? It's totally anonymous. And the second owner can hold the stocks and enjoy capital gains and dividends during his holding periods. And when he feels that it's the right time to sell, he will sell. And the third buyer will take over uh, those stocks, and then it keeps going on. It can keep going on any number of rounds, right? N number of rounds, right? And until and that can be infinite, because as long as the company goes forever, right? So anything after the primary market is then called the secondary market, right? So my sale of stocks to the buyer, that round of transaction, right, is secondary, and the second owner selling it to the third owner, third buyer, that's still secondary market. It's all so after the primary market, all transactions are basically secondary market transactions, right? Now, the companies that haven't gone public, in other words, company that's called private held company, as opposed to publicly held or publicly traded company, publicly owned, publicly traded, publicly held company, right? As opposed to that, privately held or privately owned, and privately held companies are generally small companies or mainly startups. Of course, even a big company can be still privately held. So privately held companies' stocks don't have any market uh, market value or market price because they're not traded in the market. But they can be traded uh, between closed circle. I mean, I can buy stocks of, and that's called a penny stock. I can buy stock uh, privately held companies, uh, but there is no. It's not a market. It's not done in the stock exchange. It's like if I know someone, right? If I know someone who holds the stock, um, some stocks of that company, right? Then I can, and if I want to buy that and he or she wants to sell that, there can be a transaction. There can be a buy and sell, right? Outside the market, right? It's just a private uh, uh, transaction. But again, uh, the price that I paid for that stock outside the market uh, is not exposed. I mean, there's no requirement, right? It's not mandatory to disclose that information. So another private transaction can happen, but nobody knows what was the price in that transaction. Nobody knows what is the. Nobody else knows what was the price in my transaction. So this is because it is all done outside. Now, of course, for some companies, some small startups. Um, Transaction can still happen outside the stock exchange, but just because it is outside the organized stock exchange, right? It doesn't mean that the information is unavailable. Um, uh, I mean, it's not always openly available, but sometimes it is not available. Sometimes it is available. Something called, penny stocks. What are penny stocks? Penny stocks are stocks of very low uh, face value. Um, why? Because these are the stocks of the companies that are not publicly traded. So um, they are generally small companies uh, and small startups. And of course, not all the small companies are necessarily risky, but the company that is small because it is relatively very new. Think about it. A relatively newly established company is very risky, right? Um, so, and then their shares are practically uh, no way to value their shares because there's no track record. There's no transparent, open source financial record, right? So there's no way to uh, correctly value uh, their stocks. Um, but they offer to sell their stocks. Why? Because these companies uh, need a lot of capital to uh, finance their operations, finance their R&D. Uh, so they are issuing shares of stock and sell it at a very low value, low price. Um, it's not really penny. It's not a prices. Anything a low value like $5, $1. They all called they are all called penny stock. Now, so these are examples of privately owned and closely owned, right? Um, Companies, right? Now, stocks pay dividends, right? I've been telling you, right? Which is like bond paying interest. But then the difference is over and over, uh, stock uh, stock dividends are not an obligation, right? Because it's not borrowed money, right? In case of bond, it's borrowed money, so there's an obligation to pay interest. But stock is ownership, right? You don't owe uh, as part owner of the company. you don't owe yourself anything. I mean, you just the company's management has the obligation. They owe the obligation, right? They have the obligation to give you the uh, uh, maximum return, but that obligation is not um, uh, enforceable because, in all good faith, I mean, think about it. You were trying to do well in all good faith, but some unexpected uh, crisis happened. Some unexpected economic shock, or not economic shock like pandemic uh, hit the economy. There's no, you can't guarantee to pay. So pay back, right? In other words, as you are the owner, you are part owner, right? And as part owner, you are responsible for the result. And the management is held responsible, accountable. But then what can you do? I mean, if you are the majority shareholder, right? Uh, you can, in the next uh, annual shareholders meeting, can move to sack the current management, right? Uh, so by vote, you can, sack them. Uh, but if you are not a majority shareholder, you can't even. I mean, if you're a majority shareholder, you can probably, if you own 51% of the shares, then you can always do whatever you want. Um, But if you are a minority shareholder, there's nothing you can do about it, right? And being an owner, part owner, means that you are prepared to take uh, the result as it is, or I mean, you have no one to blame but yourself, right? Uh, so if you are not ready to uh, take the loss, then you shouldn't have invested in that company. And it goes without saying, when you invest, that means when you buy stocks, that means uh, you fully understand you could lose all your money, right? So it's not like they uh, duped you into uh, taking part in the ownership. You voluntarily took part in the ownership, so uh, and you have to face the consequences yourself. Now, but the dividend, but once again, so that's why the company doesn't owe you dividend. I mean, company can pay out dividend, but they don't have to. And remember, dividend is coming out of where? Where does the dividend come out of? Hmm? What does the dividend come out? Remember, the dividend is a portion of the net profit, or EAT, right? So think about it. If a company has a lot of EAT, then they can pay out a portion of that as dividend, right? But if the company has, very uh, uh, meager profit, or zero profit, or even negative profit, they cannot pay out dividends, right? So dividend is not an obligation, right? It's not an obligation. Now, interesting thing is, when we say dividend, we mean cash dividend. Dividend is uh, generally paid out in cash, but sometimes they can pay out dividend in additional stocks, additional shares, or they pay out dividends in merchandise. But these two are not uh, these two are not what you want. Why? First of all, let's think about it. It's rare, though. It's rare. Suppose they pay out dividends in additional shares. What does that mean? Now, suppose this company has, $10 million in stock, common stock, right? $10 million. Let's say uh, the stock price or the book value of the stock at the time the stock was issued. The book value at time zero, right, at the time it was issued was $10, right? That means how many shares were issued? 10 million divided by 10. So that means 1 million shares were issued, right? Makes sense? 1 million shares. Now, and $10 the book value, right? And that was at time zero when the stocks were issued. But then, let's say a year later, if the company has been doing well and if there has been a positive net profit, then you remember the company's the book value will increase by as much as the earnings per share, right? Remember that? And so EAT divided by if the EAT, right, net profit or earnings after taxes is $1 million, right? Then think about it. Earnings per share is 1 million divided by how many shares are outstanding? 1 million. So earnings per share would be $1. Then remember what was the book value per share at time zero is $10. So then book value at the end of time one will be at the end of first year, right? Will go up exactly by earnings per share at time one. So it will be $11 then, right? But again, that's the book value, and market price will be in most cases, market price will deviate from the book value in the short run. Why? If the company has a positive company has positively growing profit, then this will be a popular company, right? Everyone will demand this company. So the market price will reflect the demand, and the market price will go up. I mean, even before time one, or even after time one, right? Even after time one, it will become the demand will even higher because now they've seen, right, for a fact that the company's earnings grew by the company's earnings was 10% of the company's EAT is or return on equity is 10% of the equity, right? Return on equity is 10%. So the positive, return would and the you verify, the market has verified that the return on equity was 10%. So this fuels more demand. So the market price would go up. I mean, although the book value at the end of year one will be $11, but the market price will be can be higher than that because of the strong demand. Now, but suppose, so they have, now in book value, in terms of book value, right? The book value per share is $11, and they have total equity at time one will be $11 million, right? And you understand that $1 million net profit is the equity, additional equity generated by operating activity, right? We talked about this, at in the second topic. So you should this shouldn't be, anything new. So that means, the equity base, the equity at time one will be $11 million, 10 million from equity at time zero, and $1 1 million from EAT at time 1. So equity at time 1 will be 11 million, right? Now, remember, the original 10 million is called paid-in capital because it's literally paid in by the original shareholders, right? As opposed to this paid-in capital, this $1 million, the equity generated by the operating activity, right? Yeah. So at the end of year 1, suppose this company has sold a new round of shares, another, this time not 100,000 shares. And thanks to the strong demand, thanks to the positive performance of this company, and thanks to the strong demand, they can sell another 1 million shares. I'm sorry, 1 million. Yeah, let's assume another 1 million shares at the book value of at the previous book value of $10. In other words, without hurting the price of the book value of the stock, right? Without altering the book value of the stock at the same book value, right? You can sell another 1 million shares. Then there will be additional $10 million, right? Because you're selling it at $10, right? So in this case, the equity value doubled because thanks to the sale, a new round of another 1 million shares at the book value at time 0. So there are 2 million shares outstanding, and the price is still $10, right? And then total equity, right, at this time will be $20 million, right? And 2 million shares outstanding, right? So therefore, if you divide 20 million by 2 million shares, then still price per share, book value per share will be $10, right? So if that's the case, nobody will complain, right? But suppose, and then because there's an additional paid-in capital of 10 million, right? Additional paid-in capital of 10 million, right? The total equity is 20 million, right? It doesn't dilute the share price. In other words, $20 million divided by 2 million shares, still the book value per share is $10. It's not diluted. It's still the same $10. Nobody would complain if that's the case. But then the problem is, if the company hasn't performed well, right? Then what's going to be the demand for this company's stock? The demand will be weak, right? If the demand is weak, can this sell additional 1 million shares? No, they can't. Why? If they sell additional 1 million shares, there's no guarantee it will sell out, right? Unless it sells out completely and exhaustively, right? At the current price book value of $10, then what does that mean? Only some of those new round of 1 million shares will be sold. And if it is not completely sold, what's going to happen? There is an excess supply of stocks, excess supply of shares, and excess supply means there's something left unsold. And if there's something left unsold, what's going to happen? The price will drop, right? In other words, there was more supply of the stocks than the demand. then the price will have to drop, right? And if the price drops, who gets affected? Who gets affected most and immediately? Of course, the existing shareholders. The existing shareholders will suffer, right? Because as the valuation goes down, then their equity uh, base will go down. Their equity investment, value of their equity investment goes down. So existing shareholders don't like it. They will oppose to a new sale of new shares, right? Unless it is guaranteed that uh, it's not going to drop their valuation of their existing shares, right? So uh, that's why I said companies cannot, after the primary market, there can be another public offering, but it's few and far between, right? Unless they are confident that there is sufficient demand to support the current price, even if the supply increases, then they won't, right? Um, that is the reason for, I mean, that explains why uh, stock price dilution happens, right? But think about it. Paying dividend in additional shares is just like selling new shares that is not supported by the demand. If it is not supported by demand, price falls. So, and this time, if you're paying dividend in additional shares, this is not even sale of new shares. So that means there's no demand buying it, right? But you just simply, let's say for every 100 shares, they are paying uh, one additional share as dividend, right? So that's 1%. So what did I say? This company in our example has $10 million in equity, and which is represented by 1 million shares outstanding, because the price is $10 per share. So uh, if you pay dividends in shares, additional shares, what does that mean? 1% additional shares, and because you're getting one additional share for each 100 share you have, sure, then there will be 1% more shares outstanding without any paid-in capital to support it, right? In other words, there will be 1,010,000 shares outstanding with the same unchanged original equity at time zero, right? Equity, which is $10 million. What does that mean? You are dividing $10 million by not 1 million shares anymore, but by 1,010,000 shares. Now, obviously, then the share price will be diluted. You got your, let's say you had 100 shares, so you got one additional share. So they paid, you got one additional share as dividend. But this is, you might, so I have, 101 shares now. Should you be, can you be happy about it? Of course, anybody sensible won't be happy about it, right? Makes sense because your total equity value is still the same. You just divide it by additional shares, right? Then obviously the fraction will be smaller, which means the price of the price will go down, right? Price will be smaller, right? So that's why um, dividend in additional stocks are not favored. Okay, and paying dividend in merchandise. This is also this is ridiculous. Uh, Usually, if they do, they are trying to unload their unsold inventory. If it is unsold inventory, then uh, that means you're stuck with the unsold inventory that you have to liquidate. Obviously, it's not uh, one of the. This is not of the favored uh, solution, right? The favored uh, method of right getting the dividend. So anyway, so the question is then what is the preferred stock? Okay, we understand what preferred stocks. Preferred stock is often considered, quasi debt. Quasi means almost debt, because much like interest on the debt, preferred stock pays fixed periodic dividends, right? So remember, dividend depends on the profit, right? Because a fraction of the profit is being paid out as dividend. So if the profit goes up, dividend will go up. Profit goes down, dividend will go down. Because if the dividend payout ratio, right, the percentage of the profit that is being paid as dividend, let's say it's 10%, right? If the dividend payout ratio is 10%. Now, if the company's net profit is $1 million, right? 10% of 1 million is 100,000. But 10, if the company's net profit is 2 million, right? 10% of that will be 200,000. So dividend changes with the profit level, but that's for the common stock. For preferred stock, regardless of the company's profit level, uh, you will always get the same dividend, constant dividend on the preferred stock. Now, if you're getting a constant dividend, it looks pretty much like annuity, isn't that right? Isn't that right? Right? Because annuity is a constant amount paid at regular interval. So this is the constant amount, and it is paid at regular interval. In case of quarterly, right? In case of stocks, remember, dividends are paid quarterly, so it's a regular constant amount paid at regular intervals. So there's an annuity. But then the difference between that's the similarity. That's the similarity with the bond. But the difference is bonds have maturity, right? There's an end point. But stocks don't have maturity. Stocks go on forever. So there's no end point, right? So what do we call such a thing? It's called perpetuity. Perpetuity, right? Perpetuity is like annuity, uh, going on forever, right? Uh, and it's less risky than common stock. Why? Because common stocks cannot pay any dividend, right? Uh, Before it pays dividend to the preferred shareholders. So as I said, company if the company didn't make any profit or even made loss, there's no way to pay out dividends. So that means that also includes, preferred stock, because anyway, the source of dividend payment is is coming out of the profit, right? So if the profit is zero, there is no way uh, you can pay dividend, common or preferred. Okay, but let's say the company is doing better and they net profit, so they can pay out dividend. But they will have to pay out first to the preferred stock, and if there is money left over, then they can pay out to the common stockholders, right? So for that reason, preferred stock is less risky than the common stock. Okay. So as I said, they will have, if they don't have any money to pay out dividends, then they will have to skip the dividend. For preferred stocks, there are two types depending on what they do with this skipped or passed up dividends. Now there are two types. One is cumulative and the other one is non-cumulative. Cumulative preferred stock pays dividend in arrears, right? The dividends that have accumulated while it's skipping, right, or passing up the dividends, right? So if it is a cumulative preferred stock, they will pay all the accumulated dividends, right, held in arrears before they pay the dividend for the current quarter, or so anyway, that's cumulative. And non-cumulative preferred stock means the dividends, the past dividends or the skip dividends are not paid, right? They are just simply gone, just like common stock, right? Either way, the common stock cannot be paid until preferred stock dividends are paid first, okay? Now, some preferred stocks have call feature, just like the callable bonds. They also have conversion feature, converting to common stock, right? Some of them, right? Okay, that pretty much sums up everything about the preferred stock. Now, what's interesting in the stock is IPO, going public, because a lot of high-tech startups are they started out originally as a privately held company, and then they get funding from the venture capital to grow, and then once they have met certain requirements, then they go public, meaning selling stocks and stuff. And when there's this IPO, initial public offering, when it happens, then it can be a chance for tenfold, even tenfold return, right? Why? Because when it is privately held, when it was privately held, there's no the price is just book value, right? And then if this company has racked up sufficient reputation and positive reputation, right? When it goes public, right? All that positive expectations would explode in the pent-up demand will explode, right? And then the price will shoot up like crazy. And at that point, if you were one of the original founding members, or stockholders when it was privately held, then you gain, right? You see overnight. Of course, the value is just the paper gain, right? Until you sell, it's the paper gain. So think about it. Let's say I was holding 2,000 shares, 2,000 shares of a company called Moderna. Moderna, Moderna, or Moderna is but it's already public, right? But let's say a company called X. a, company in pharmaceutical that is, developing a COVID-19 vaccine. And the companies that are, and this company is not public yet, it's private, and I'm one of those uh, original shareholders. And book value was, just $10 per share. So I was holding 2,000 shares, and so that means $20,000 in book value. And let's say this company is, currently, pending the FDA approval for the vaccine. And let's say the vaccine is finally approved by the FDA, and then they go public. What's going to happen to their stock price? Their stock price will explode, right? And I, having 1,000 shares, which was, $10 per share, right? And I have $20,000 in this, in terms of, in this stock. Now, on the IPO day, it jumped from $10 to $100. That's a tenfold, right? Tenfold is what? 1,000%, right? Actually, the return will be, 900% because actually from $10 to $100, right? The growth portion alone is only, $90, right? But anyway, if that happens, my valuation will be now from $20,000 times $200,000, right? And if I sell right away, then I realize that gain, right? I realize the return. But if you don't sell, it's just paper gain, right? But anyway, the idea is that's why IPO is so hot. Everyone wants to jump in on this bandwagon, and everyone wants to have a piece of it. But then it's not like everyone can jump in. Why? IPO is strictly on invitation basis. Invitational. It's not like you can buy. Strictly invitational, and then who gets invited then? Of course, institutional investors. Majority, big, who is inviting them? The brokerage firms invite then they will invite their major clients who have like, $1 million, in at least, like something like that, $500,000 plus, right? And those, as individual investors, if you have like $1 million in with a brokerage firm in your account in the brokerage firm, that is a very wealthy individual investor. For institutional investors, of course, it's a piece of it's a peanut, right? But anyway, so only select few individual investors can be invited. And if you're one of those who bought those shares at IPO price, and then within the day, the market price jumped. IPO price was, let's say, $50, and then the price jumped to $500 in a matter of a week, right? You buy it at 50, and you sell it at 500. You realize really 1,000%, a 900% gain, right? But again, since generally, small account individual clients are not invited, generally not invited. The first time you can lay your hand on it is in the secondary market, not in the primary market, right? So IPO stands for initial public offering, as I said, So, and I told you, public offerings. There isn't only initial public IPO. There's second public offering, third public offering, right? But second and third public offerings will come later when the company is more mature than a startup, just a startup. And if they do, they will need to have a proper justification, right? In other words, they will need to have the justification good to support to have enough demand to support the share of new uh, uh, shares, right? Sale of new shares, right? Otherwise, it's totally, it could, it will only dilute the share price, right? Now, let me try to. And so let me quickly check. Um, and other than public offering, there's something called rights offering. And rights offering means what? Um, Instead of make a public offering, if they need to raise new capital, additional capital for let's say $10 million, right? Then they will, in, of course, they will issue new shares, but they offer it to the existing shareholders first, right? Uh, I mean, if it is, and if the existing shareholders, especially if it is a relatively, small number of additional shares, right? Um, existing shareholders will, existing shareholders are holding their stocks because uh, they are more, uh, optimistic about this company. So the chances of completing exhaustively uh, the sale of new shares is more feasible, right? You can exhausting all the shares in sale completely is very important because once again, remember if you issued new additional 1 million shares and these 1 million shares uh, failed to sell completely. In other words, it doesn't 1 million shares don't exhaust, right? Don't get exhausted, then don't sell exhaustively, right? There's something left over, right? That's going to dilute the stock market price of the stock, right? So they don't if they don't want to risk that chance of stock price dilution, um, uh, they would first offer it to the existing shareholders, right? Uh, and but there's a better chance of and then the third one is a private placement. Private placement is only contacting like large institutional investors because they are institutional investors. They can they command more capital, right? They can mobilize. Also, they can mobilize a lot of capital, and they can relatively easily, if, for example, a small scale, right, on a relatively smaller scale, if they are raising new equity capital on a relatively more small scale, like 5 million, 10 million, 20 million, right? Uh, uh, by uh, contacting and negotiating with the prospective candidate who can, and institutional investors like insurance companies, they have huge uh, uh, cash holdings that they need to invest. It can, you can easily cut out a deal, and you can exhaust uh, like a tailored deal, and you can sell like 1 million shares and for $10 each, and you can easily raise $10 million from a particular individual institutional investor. So private placement. So they risk uh, uh, little. I mean, the company issuing new shares will be uh, risking uh, will be facing less risk of failure to sell, risk of failing to sell all exhaustively all uh, the shares, right? Now we need a little more time on IPO, because the process and the parties involved. This will require more time to discuss, and we are right now simply we're almost out of time. So uh, we'll uh, we'll pick it up from here in the next class. Okay, so that's it for today. Uh, I'll see you guys in the next class. End of video.